This is Sasha. We are on next episode of Building the Open Web podcast. And today we have Jake Brukhman from CoinFund.
Hi, Sasha. Nice to see you, and thank you for having me.
So, you're like pretty much OG in the space. I wanted to start with very beginning. Where did you grow up?
Well, so I was actually born in Russia, like I believe you were, but I immigrated to the United States pretty early in 1990, and grew up in on the East Coast. Studied math, computer science, went to grad school for math at NYU, and then worked in the hedge fund world for a number of years, and then in the pure tech world as well, and then was a CTO of a fintech startup.
So, what was your initial interest in hedge funds, fintech, technology? Why this angle specifically?
Well, I was like really into math, and computer science, and already in high school, I actually learned how to program when I was 14. Like both of my parents, both my mom and dad were engineers, and so it was more of a question of like, how do I apply like that background? And because we were in New York, and this is what they sort of have had done, being on Wall Street for a number of years. It made sense for me to go into that field where I could use both math and computer science, in the realm of finance, basically.
hmm And then you tried to essentially start your own fintech company as well after?
I joined as a partner to a firm called Triton Research, and we did some very interesting, basically tech market research where we would analyze technology companies that were maybe going to go IPO or would eventually IPO, like Uber. But the way that we did it was by sourcing publicly available data on the internet. So we did use a lot of technology to source that data and to create the models for the products that we sold. And it was a very interesting sort of process, and it taught me like a lot about companies.
I see. And how did you get into blockchain space for the first time?
I got my first Bitcoin in, I want to say, April of 2011. I had a friend who, was on some cryptography mailing list. It's so interesting. He introduced me to Bitcoin, and then like years later in 2017, I called him up again and I said, "Hey, you must be like swimming in Bitcoins by now." And he was like, "Bitcoin? What's Bitcoin doing?" And so he like didn't even follow the space for years. But after that phone call, he got back into it, and now he works at one of the crypto startups in San Fran. But that's how I got into it, and then I became an investor in Bitcoin on Coinbase at the end of 2013 in November. And then in 2015, I launched CoinFund, and we basically mined some of the first blocks on Ethereum frontier, and it all went from there.
What was the initial plan and vision for CoinFund?
That's a good question. I'm an engineer, right? So like my inclination was, hey, let's like start a startup in blockchain. But I quickly realized that this was like such an early time. I mean, this was 2015, and the space and the technology would grow and iterate so much. I was like, maybe if we start a startup now, maybe we'll quickly obsolete. So what's like a different strategy for investing? And then it sort of became obvious that digital assets, or at least I was hoping that digital assets would become a new asset class where more democratic access to investment was possible. And actually, like kind of the very early ideas around CoinFund were very naive, and they were like, "Oh, let's make it a public fund where everyone can invest in a hedge fund, right?" And that's only like starting to happen now, 5 years later, with the advent of all of DeFi and fund technology and a lot of like work with regulators and so on. But back then, it seemed like a good idea, but I quickly realized like it wasn't going to work that way. And so it seemed like we should start a fund, we should invest, we should follow along, we should work very very closely with technologically minded founders, and that's what we did. And I think CoinFund has done a good job of like at the same time being quite a technical team and understanding all the technology very deeply, but also like bridging the gap to traditional investors. Like all of our partners worked on Wall Street, including myself at some point, right?
Yep. And what did it evolve into like many years later now?
So we had our initial fund that we launched in 15, and that was more like an experimental fund. And then in 2018, we launched our second fund together, or backed by the partners at Venrock and David Packman. And so we had a very, very fruitful relationship with David and the Venrock team for the last 2 years. And this year we launched our third fund, it's more like a liquid strategy, which is led by a gentleman named Seth Gins on our team who joined us in January. And now we're going out to launch a venture fund this year as well.
Wow. And so, as you observed the space, what did change for all this year? So I imagine it was like insane amount of change every single year, right?
I mean, to say the least, yeah, like every 3 months, I remember I think 2015 was fairly slow, right? Like it was watching mostly Bitcoin, mostly like how is Ethereum trading, right? People were like very, very price focused, and it was like a little bit it was a little bit watching kind of the side projects and what products they were proposing, but it was so early. And what started to happen, and it really started, I think, on Ethereum, right? Like, Maker, which is essentially the first project in Ethereum, started kind of pre-sell kind of some of their assets. Augur had the first ICO on Ethereum, and I believe it was August 2015 into September 2015. Then we saw Digit, right? And I think that was in November, and that ICO sold out in like 9 minutes. And so you had these like very rare but very impactful events where, it would take like a lot to get an ICO together. But once you did, it went really fast and people got really excited about it. And so I think that led into kind of more activity in 2016. I think, at that time it was still very hard. I remember watching startups like, oh, trying to raise $1 million in an ICO, and it would be like very, very slow, right? And then that momentum built over the course of the year, and then by 2017, well, I'm sure you know what happened then. It really reached like kind of a fever pitch in the market. But this is what sort of my mindset was back then. It was like watching this very exciting technological space with a lot of people kind of interested in it, but no one was like sitting there and making sense of it. Everyone was just very focused on trading and what is this and what is the investment opportunity, but no one was saying like, can we build like a model of how this will develop? What are we actually building here long term? And so, in 2016, we started a Slack channel, the CoinFund Slack, and it was really one of the first venues where people could go and really do, kind of a more, I don't want to say professional because we were not really professionals at that time, but it was more professional oriented research where we were trying to understand the technology, we were trying to understand the trends, and we were reasoning about it scientifically. And I think that attracted a lot of people to our channel, and sort of really helped us to, with their help, right, with the help of our community, to make sense of the space. And I feel like it's at that point that we started to understand the space like a lot better. And then nowadays, of course, we have tons of research companies, tons of research channels and groups, and we were one of the first ones.
Nice. And how would you describe 2018 and then 2019?
Well, so predictably, we had this sort of bubble event, which popped, I think, at the beginning of 2018, and we went into a bit of a quote unquote recession in the crypto market. The market went down, and a lot of people called that out pretty fairly, I think. And the one surprising thing was I thought that it would last for about a year, and then we didn't, we saw a lot of like bad actors essentially leave the space, but we saw in 2018 a lot of technologists building and still continuing with their tracks of doing things. And so I thought that like in 2019, like the markets would come back, and they started to come back a little bit. But ultimately, that crypto winter really lasted 2 years, not one. That was the surprising bit. And as I wrote in my CoinDesk year in review at the end of 2019, I looked back on that year and 2018 as well, and I really saw that as an infrastructural phase where folks like yourselves at Near Protocol, right, built out kind of new technology and kept going. Tried many different applications on top of Ethereum, tried different models, tried app dedicated networks, developed zero knowledge proofs, and many, many other areas. And kind of the core, I would say, like theme underlying all of this is really been like a search for how do we make these companies in blockchain that, that come together to build products, like how do we make their businesses sustainable, right? And how do we fund these? And what are the right models for funding? Where like an ICO is not right for everyone, a continuous token is not right for everyone. For highly decentralized things, and equity financing is not right for everyone. So like this process over the last 2 years, I feel has also been really understanding like what are the correct financing models for different kinds of products and teams. And as a fund, that's a very important aspect, right? Because, like for example, in our second fund, we can invest across all those kinds of stages. We can invest in early stage equity. We can invest in later stage liquid assets. Generally, not things that one fund does at the same time, right? It's a hybrid. And then more recently, as these like networks actually come to production, we're also engaging the networks directly. We're staking, we're voting, we are adding supply side hardware to certain networks that are in our portfolio. We're perhaps mining or software mining certain assets, right? And so, what has really transpired over the last 2 years is a learning process of how decentralized networks and products built on top of them come to market, and what are the right models to do that.
Would you say it's still like experiment, kind of like work in progress? So we got to some models that are like really working.
Well, it's absolutely still experimental, but I think like where our first fund was very focused on like digital assets only, our hybrid fund can invest in equity. And that shows that kind of the market feedback was, hey, you know what? Like in very early stages, equity is sort of the right thing. And then that maybe converts to tokens later, or maybe there's just a centralized business that works on top of a blockchain. And that's fine. That's a perfectly good investment opportunity if the product is good, etc. I think ICOs, the way that we did them in 2017, largely taught us a lot of lessons, right? But I do see that the part of the experiment that has worked out is this kind of regulatory attitude, and kind of the SEC even has said, right? If you have a network which is quote unquote sufficiently decentralized, no one has defined that exactly, but if you have a network that's sufficiently decentralized, you're creating assets that are commodities. And so just yesterday, right, we had this UMA protocol sale on Uniswap, and I kind of felt looking at it that one of the reasons that the team was able to do that is because they had a high confidence in their network being a very decentralized product. And so I think like one thing that has happened in the last 2 years is that we have finally gotten such products sufficiently into production to at least play with them and see how they work. Are there going to be other models possible? Absolutely. I am really looking forward to, kind of bonding curve token models, continuous financing that's compatible with different, compliance frameworks of different countries. And I'm also excited about security tokens like Props, a project that we've worked with for a long time. Got the first Reg A Plus along with Blockstack. And I think they have some very interesting stuff coming to market like before the end of this year. And I think in the future there'll be even more models that we're not thinking about.
Mm-hmm. Interesting. And so then you also mentioned that essentially as a fund, you also found a lot more ways to participate across different life cycle stages of the companies.
Yes.
Do you see a lot of other funds doing this, or do you see that CoinFund is like essentially the one that's doing all of this, all the stages versus other funds are not so much yet focusing as much on this flexibility?
So I don't know too much about other funds, but people, these are open networks with open opportunities, and so they're available really to anyone who wants to take the time to, learn the technology, to learn how the network works, etc. So, you know, um, back in 2018, we did a lot of work on this concept of what we call generalized mining, which is essentially the idea that you can earn alpha in a protocol by doing something useful, right? By providing liquidity, by staking, which is providing security, by providing sort of supply side resources like hardware or computational power or something like that, right? And and I do feel like funds have recognized the value and importance of that. And for example, you see that because a lot of the holders of tokens, they want to stake them, they want to put them to use. that has spurred a certain market of staking service providers as well as infrastructure providers, that run nodes on these networks like Blockdaemon, which is one of our companies, but Bison Trails as well. And I often hear this story of like, networks want to be highly decentralized, so they'll take on many such providers, right, to give their customers the ability to stake on the network. As custodians come online, so this is more thinking about the traditional investors, right, who want custodians. Well, they start having to think about like, do I just hold these assets, or should I be able to put them in the protocol as well and earn the kind of inflation reward of that protocol? And it's interesting because if you're paying a custodian, but the custodian is sending your assets to a smart contract on Ethereum, let's say, what are you paying for? Is it insurance? Is it sort of, does it make sense? So like, there's a lot of interesting kind of questions there. I feel like our team has gone beyond staking, right? So we've done kind of one of our best case studies that we wrote a lot about has been in the live peer Merkle mine, which is software mining. It's a token distribution mechanism. We became one of the largest miners in that mechanism, and took risk to distribute the asset, and also got rewarded in the asset. So now this year LivePeer launched their full production network on January 13th, Streamflow, and it's looking very healthy, it's looking very decentralized, and super excited to see some live streaming video built on top of them. And another example of this kind of really active engagement in networks is the recent vote at the Digix DAO, which dissolved the DAO and returned capital to shareholders. And this was a project that we literally followed since inception in 2016. And the community of this project said, "Look, we don't think this DAO, which is really kind of the second DAO in the world, um, we don't think this DAO is working well. It should return the funds." And the mechanism was that like the majority of shareholders in this DAO needed to vote to dissolve, but of course there was a small group of whales that kind of controlled the vote, right? And so the founders kind of graciously said, we're going to abstain from this vote, and if you guys can get enough interest in the market to dissolve the DAO, do it. In the end, there was a mega whale, and he was like, dissolved. And so the DAO was dissolved, and that actually created a return for the participants in that experiment because the underlying ether of the DAO was worth more than the tokens that were used for voting. And so you can participate in the network as a holder. There's really a lot of room for research here. Like we build probability models of how the vote was likely to go based on on-chain data, based on who we knew was holding Digix tokens and how they were going to vote. And what the model showed was that it's very likely that this vote would get quorum. We didn't know if it would go yes or no, but it was at least possible to pass it, right? And so we bet on that, and kind of miraculously it worked. That was like a really, really cool case study.
I know you actually wrote about voting, right? Like, what do you think would be the future of voting? How would you alleviate this problem of essentially like whales defining the outcomes?
Well, the first thing to think about, when you think about whales in the voting system is like, can we just measure how powerful they are? And what I've written a lot about on this topic is something called the Bonshoff Voting Power Index, which is essentially like a mathematical measure from game theory. And what you do is you say, okay, I have a voting system. It has like, this many people, and this is how many tokens each person has. Can you tell me like what percent of the time any given voter will be able to swing a vote, right? And so what you find is that the people with like a small number of tokens, they are hardly relevant to the voting system. And the people who have a lot of tokens relative to them, they actually have this disproportionate power to swing votes more often. And so you might have only like 10% or something of the token supply, but you might be able to decide like more than 50% of the outcomes in the voting system, right? And so all of that, it depends on like what the actual distribution is, and not just how much money or how many tokens you have, but also how many tokens everybody else has relative to you. And so the bonds have voting power index is this measure which allows you to like measure that. And what you can now do is I wrote some software where you can like calculate the index on different token supplies, which is a bit of a math problem, computation problem. But like once you do that, right, like you can compare different governance tokens and say, okay, this distribution is more fair, more widespread, or that distribution has a whale that is essentially a dictator of the system, and you shouldn't go into that system because you're not going to have any power. Or in the case of like Moloch DAO, right? Like if you find that the distribution is unfair to you, you can go and rage quit. And so, so just visibility on how these systems work and who has the power in such a system is already starting to become kind of a powerful quantitative tool to make decisions. And secondly, there's been a lot of talk about like over the last 5 years, right? Like what makes tokens valuable? And a lot of investors have, maybe like Placeholder and others, right, have said, we think governance tokens will actually be kind of a really interesting approach to a token that actually accumulates value because there's value in governance. If I have a company that runs on some system, my company has an interest in what the API of that project is. And if the API wants to get changed, like I want to be part of the governance mechanism that decides that. And so if you think that governance tokens like Aragon, like Zero X, like Comp token from Compound, if you think those tokens are going to be valuable, then what you might want to do is measure the voting power of the participants because that might help you relatively value what a given stake is relative to another stake. And if you know the total kind of valuation of the project, then that allows you to actually come to kind of a fundamental valuation of tokens. And so this is an approach that, that is, I think is kind of interesting to think about in the context of valuation as well.
Yep. And also, what do you think about adoption patterns? Like, have you seen? Because the thing is, like, with new marketplaces, like for example, like LivePeer, could be on one hand looked harder because you don't have like company like in traditional space like eBay's of the world back in the day would raise a whole bunch of money because they would be like trying to bootstrap supply and demand themselves. On the other hand, you have tokens, right? Like new incentive systems to bootstrap liquidity and marketplaces. Have you seen something that's working really well on that front?
So let's make a distinction. So I think like so far, most of the stuff that's actually monetized in blockchain has largely been sort of financial applications. So you're talking about exchanges, you're talking about trading, you're talking about custody, security, like for that side of things, right? Derivatives platforms, etc. If we sort of say like let's put those financial things aside and let's look at consumer blockchain, like where what are we, how are we doing in social media, how are we doing in marketplaces, how are we doing in resource networks? What you find is that here, like in that side of the market, there's actually very very little adoption, but there are certain areas that are seeing more activity than others. One of those areas, interestingly, is NFTs, right? So this is like a very very early market where creators are creating visual art. They're creating collectibles like crypto kitties, just different like block cities is another example of like little buildings on the blockchain you could collect, in-game assets, and then other classes of NFTs are like address space, like domains, ENS domains, and so forth, and then a long tail of like financial. So what you see in the NFT space is actually growth. Like the standard for NFTs surpassed ERC20 transfers on chain at the end of October, early November. And then since then, into at least the end of January, has done like another 200%. So there's more people moving NFTs on chain in the last 6 months or so, substantially more than people actually moving cryptocurrencies. And that's super interesting. I think a lot of that is driven by games. If you look at the top 10 assets on OpenSea, you'll find like four virtual worlds, two art platforms, I think three games, and I think like urban address space, right? And what's super interesting is that even if you look at the virtual worlds, like the reason why, like the number one use case of virtual worlds today is building art galleries inside of them to display NFTs. So it's really like six out of the top 10 things almost are like trying to be art related right now. And then for the first time, art platforms, two of them are in the top 10 at the same time. Might have happened temporarily before. Also, crypto voxels land surpassed Decentraland land in volume in the last 6 months, and Decentraland has usually been kind of the top NFT most of the time. And so I would actually say that in the non-financial side of blockchain, where I see the most activity is in NFTs. And the kind of GMV, the gross marketplace volume, well, if you look at the on-chain metrics, OpenSea is doing something like a million, maybe like a million point two over the last like 3, 4, 5 months on chain, and so we could extrapolate about like what 12 to 14 million of GMV just for OpenSea, and OpenSea is kind of the largest marketplace for NFTs. And then if you add in, the super rares and the known origins and the rareables and the async.arts, you probably get to something like 20 million of annualized GMV. And so, like, I can't really name another consumer facing, like, I can't name like blockchain social media companies that are doing 20 million of GMV, right? Can you?
No, definitely not.
Definitely not, right? Now, on things like LivePeer, these are also non-financial applications. We call these resource networks. So you're taking some computational resource, in this case, it's video transcoding, and you're allowing that to go on a decentralized network. Now, you're totally right. It's hard to build two-sided marketplaces, but in the case of LivePeer, I think they have a very interesting advantage. And the interesting advantage is price. They can compete with pricing that even like cloud platforms, can do today. So like, I don't have like the exact numbers in front of me, but from these beta tests that LivePeer has done internally, they could probably improve transcoding prices 10x relative to AWS, and that's a huge deal. And the reason why you can do that is, essentially like merged mining. You can transcode video and mine cryptocurrency with the same GPU, and that creates this sort of cost advantage. And moreover, it's an open network. Like, people can optimize data centers the way they want, plug into the network, and create other like price advantages for themselves, and so on. So while it's hard to build marketplaces, that's true. It's actually easy to give customers a value proposition like, hey, this is 10x cheaper. And I think what that does is it opens up this like middle market of startups that like wanted to use video for their products before, but really found it to be, too expensive. And now they can do it. So that's super cool.
Interesting. Yeah, the way we think internally overall is that if transaction, like, you look at the space overall, like, and I think the design space of use cases is like fairly narrow if you look at the last 3, 4 years. And on the other hand, now if you can drive transaction costs, I'm talking about like layer ones, if you drive transaction costs 100 times cheaper, like 2 orders of magnitude cheaper, and if usability is actually done in such a way where you can actually compete for mass market, I think we can actually dramatically expand number of use cases and kind of get to those places you mentioned that don't have adoption today, like social networks or web scale kinds of applications. Like, I'm a big fan of audios, for example. That's
Yeah, that's a great example too. Or just like simple things like, you talked about efficiency. Like, I tweeted about this. It was a very, very well received tweet for me. But I said I funded a startup the other day, and I sent them money, not through a wire, but basically I sent them USDC. And when I did that, I didn't pay a wire fee with my bank. I didn't pay a wire fee with their bank. It felt like I was sending dollars, and the transaction, it took 12 business days to clear. No, of course not. It took 17 seconds to clear. And so, just creating that kind of efficiency where you've saved someone, just 3 days of waiting for capital or something like that, creates opportunities to expand markets, right? So if you have cheaper video, you can have more people creating video, or integrating live streaming into their products. If you tell some of the creators on like Behance.net that, hey, by the way, you can upload your artwork to Super Rare and monetize it, and just because you're a professional creator, it'll actually sell for like hundreds of dollars. That never entered their minds that they could monetize work like that on the internet. It's just that those markets didn't exist, and they now exist because of these efficiencies of moving capital. So what I see blockchain as doing overall is just, by increasing efficiency, you're growing all kinds of markets. You're creating new kinds of markets that really didn't exist before.
yep. That makes sense. And now going into kind of like this whole pandemic situation, what do you think would be the impact of this? Because a lot of people like losing jobs right now. On the other hand, like online services growing like crazy, people staying at home. Do you think we'll see emergence of some new services? And overall, like how does it affect founders? How does it affect the ecosystem overall?
Well, just really quickly on that, I feel like so there's two tracks you can look at this, or two lenses you can use here, right? You can use sort of like the financial lens, like how is crypto doing in the context of broader global financial markets, and then you can think of blockchain products as a technology for times when we are in quarantine and lockdown. And so I would say, first of all, to answer your last question, I've actually talked to a lot of teams that have told me, hey, by the way, we're in blockchain, we're a distributed team. This doesn't impact us that much because we work from home anyway, right? Like, so I feel like there is less impact on highly distributed teams. The financial lens, and a great person to chat about this topic on our team is Seth, because he watches he's got 18 years of Wall Street analyst experience in the public markets, and so he watches the public markets, very closely, even as he's deploying capital in crypto. And his take, of course, and this is in line with a lot of what other fund managers in crypto have said, is that we just produced this incredible stimulus. So it's buoying the stock market, it's buoying traditional markets. I feel like we've mitigated this kind of disastrous crash. But ultimately, the way that we were able to do that is by printing $6 trillion of dollars in the United States. And the sort of inflationary impact of that has not really been felt in the society yet, and it hasn't really been reflected in prices, and it hasn't been really reflected in investment. And when that happens, a lot of managers do think that that is a huge catalyst for crypto. It's a huge reason to buy Bitcoin. Bitcoin has always been kind of touted as like the cure for government inflation in fiat currencies, right? And so there's a huge thesis right now that that's happening. And if you look at the Bitcoin price action, it seems like we recovered very quickly from this crash. And it seems like things in combination with the halvening that's coming up in about 2 weeks, it seems like we're really on a trajectory to continue our 2020 upward movement that we saw in January and February as well. On the product side, you see like obviously a lot of quote unquote non-essential businesses have suffered. So restaurants are closed, barbershops are closed out on the streets here in Brooklyn, but certain connectivity technologies like Zoom, video conferencing, have actually seen incredible usage. And I remember reading some stats where I think Zoom went from a few tens of millions of customers to like 200 million customers in a few weeks. So they've seen some growth. Does that create drivers for blockchain technology? I definitely think it does. Like, I think people are using more video. They might want to think about using live peer to deliver that service cheaper. There's also been obviously talk in relation to the stimulus of like, what's the technology that we should use to deliver stimulus? And frankly, the IRS stuff has been really disorganized. And in the stimulus bill, at some point there was even a mention of, hey, maybe we should use like a digital dollar for this. And of course, the best candidate technology to implement such a thing would be blockchain, right? So I wouldn't be surprised if the pandemic sort of circumstances become a catalyst for sort of some of the Web3 technologies like stable coins, like delivering stimulus, tracking healthcare on the blockchain. That's one industry that's so behind. Even contact tracing, as some people have been discussing with respect to social media and things like that.
Hmm. And where do people can find more about you or any digital art projects that you have online?
Sure. Well, the best way is probably to follow me on Twitter at JBRUKH, Jake Brukhman. I also sort of my side project is a digital art gallery called First Edition. So you can check that out on firstedition.xyz. Sign up to our newsletter. We send out like cool metrics about the NFT space, and we have some very, very cool artists in our portfolio as well.
Cool. And what's your overall parting advice to founders, entrepreneurs, new people entering the space?
Yeah, I mean, I think it's a really, really excellent time to get in to the crypto native side of things right now. And part of the reason that I think that is that we've built out a lot of infrastructure. We have three box identity. We have blockchain based domains like on ENS. We have distributed decentralized storage. So now you can store, domain data of your application more easily. We have a number of options for programming. We have different base layers that provide different value propositions of how apps can be built and how fast they can operate. We have established a bunch of funding models like, VC style models of the past, but also crypto native models like selling your token on Uniswap, as we saw yesterday. And really, this is the time to like live and breathe these kinds of blockchain technologies as a founder. Like use them to take your startup to the next level. And my advice is to explore that right now.
Cool. Well, thanks a lot for coming today.
All right, Sasha, thanks so much for having me.
Thank you for listening. You can find more episodes of this podcast at openwebcollective.com. If you're a founder looking for help with product, go to market, or fundraise, apply on the same exact website. It's openwebcollective.com. If you really like this episode, I would really appreciate if you give us a review on a platform of choice where you listen to podcasts to. And finally, if you're on Twitter, we are at OpenWebFounders. Again, the handle is at OpenWebFounders. I'll see you next week.